What's up, peeps? This is Todd, and welcome back to my show. Today, I want to talk about why I personally do not buy whole life insurance. If that sounds good, let's hop into the video. Now, real quick, before anyone freaks out or loses their mind, this is just a video on why I personally don't buy it. I won't say if it's good or bad for you. I think in this day and age, anyone could be offended about anything. Like, I could make a video about why I personally choose not to eat green eggs and ham, and there would be somebody out there in the comments saying, "But Todd, I love green eggs and ham, and the fact that you don't like it is a personal insult to me and all of my family. Shame on you, Todd." And it's just like, okay, well, that's fine. We're not always going to agree on what's good or bad, but I think I have a very unique approach to this because, remember, I am a licensed life insurance agent. I am licensed to sell every type of life insurance policy that there is, and I would stay away from whole life and universal life. Although I have a license to sell both of those policies, I have never once sold it. And I have never sold whole life insurance for the same reason I've never sold an Amazon FBA course. I think it's a ripoff, and I don't think you need it. So for the purpose of this video, I'm just going to show two different scenarios where you could basically buy term insurance or buy whole life insurance. Now, for anyone who doesn't know the difference, term insurance is you basically pay life insurance for a specific term. There's 10 years, 15 years, 20 years, 25, and 30 years. For this example, I'm going to do a 30-year term. That's actually what I have on myself, and that's what I got for my wife as well. So I'm going to look at a 30-year term for $250,000 as opposed to a whole life policy for also $250,000. Now, the biggest difference, other than the price, of course, between term and whole life, is whole life does have a guaranteed death benefit. So, for example, with term, if you pay for that 30-year term, 30 years pass, and hey, you're still alive and kicking, that policy now is over, and there's no benefit to you. There is no payout if you haven't died. With whole life insurance, you basically pay on it for your entire life, and then when you die, you will be guaranteed a benefit. It also has the possibility to build up some cash value that you can cash in, but usually the cash value is much, much lower than whatever the face value of the policy is, which we will get into later in the video. But so basically all you need to know, term life insurance is cheaper, but the death benefit is not guaranteed. Whole life insurance is much more expensive, but there is a benefit at the end. So let's look at these two options for a moment. We have a term life insurance of 30 years for $18 per month, and then we have a whole life policy that you're basically just gonna have your entire life, and you're paying $99 per month. Now, for this specific example, you'd be paying $18 a month for 30 years, or you'd be paying $99 a month for your whole life. There are whole life insurance policies where you can do a paid up or prepaid. Basically, you pay a lot up front and then you don't have to pay on it again, and there's still that guaranteed death benefit. But for this, just to make numbers easier, we're going to assume that you're paying $18 per month for 30 years and $99 per month for your whole life. So let's assume for both of these scenarios that you can get one of these plans when you're 30 years old. So you're either going to be paying on it until you're 60 with the term life insurance, or you're probably going to be paying on it until you're 85, which is, let's just say, the life expectancy in America. So what I'm going to do is get out my handy dandy calculator. I'm going to look at that 30-year term of $18 per month multiplied by 12 months is $216 per year. So basically that's what you're paying every month towards this term life insurance. Now, what if instead of paying that amount, you took that $216 and you just invested it in the S&P 500? So I will go to my compound interest calculator next, and you're going to be investing it from age 30 to 60. So you're going to have 30 years to grow, and we are going to assume an average annual return of 8% because historically it's gotten anywhere between 9 and 11%. So let's be a little bit conservative here and call it 8. So basically, over 30 years, if you just invested that term life insurance instead, you would get $26,426.71. Now remember, if you were to die anywhere in that 30-year term, you get a payment of $250,000. But even if you don't die, and we're hoping that you don't die, your opportunity cost is $26,000 because that is what you would have gotten instead if you invested that $18 per month in the S&P 500. But now let's run that same scenario at $99 per month times 12 months is $1,188. So remember, you bought this whole life policy when you were 30, and we're going to assume that you're going to live to the age of 85. So you'll be paying $99 a month on this thing for 55 years. Let's see what would happen if you invest that money instead. So again, you're starting with zero. You're putting in $1,188 a year because that is $99 per month. You have 55 years that you're paying into it. We're going to assume that you could be getting an 8% in the S&P 500. By the time you actually go and die, your opportunity cost is over $1 million. And remember, the face value for this policy, this whole life insurance policy, is only $250,000. the same amount for the term insurance policy. Now the difference is if you decided to not go with the term insurance and you just invested that $18 a month, you would have $26,000, which is great, but not necessarily life-changing. However, in the whole life scenario, if you were going to, instead of getting whole life, just put it away in the S&P 500 over that same amount of time, you would have well over $1 million. And again, that policy is only worth $250,000. In the term life, the policy is still worth $250,000, but what you lose in opportunity cost is $26,000. So the opportunity cost for the whole life insurance is way, way more. Last time I checked, $1 million is a lot more than $26,000. But now let's take a look at one other scenario, because what if you do die within those 30 years, or what if you do die, at year 31 or whatever it is, because the whole point of having insurance is you never know what's going to happen. So you do want to be able to protect your family in case of a disaster. And again, I am saying this as someone who's licensed to sell any type of life insurance policy there is. I have term insurance. My wife has term insurance. If any of you guys ask me to sell you whole life, I will say no, because I think it's a ripoff. So let me just put that out there right now. But let's take a look at what happens if you buy term life insurance and then you invest the difference of the whole life insurance. So for this, I'm going to get my calculator back out, and we are going to do $99 minus $18 per month, so $81, multiplied by 12 months equals $972. Now, if we go back to our compound interest calculator and I put in $972 over that same 55 years, because basically what we've done is we've decided to buy the term life insurance at $18 a month. We've looked at the whole life insurance of $99. We've taken the difference, which is that $81, and we're putting that away in the S&P 500 for the same amount of time that we would have bought that whole life insurance policy on. So now when we calculate that, you are left with $891,165. So let me explain this real quick. We just saw a couple of scenarios. So number one, you buy term life insurance, and for 30 years, you basically have this $250,000 death benefit if you die. If you don't die, which again, we're hoping that you won't, that policy goes away. With whole life insurance, you have that same $250,000 death benefit, but the opportunity cost is over $1 million, because instead of paying $99 per month for 55 years for whole life insurance, you could be investing it, where the opportunity cost for the 30-year term is a lot lower. It's at $26,000, and that's assuming that you would be getting 8% in the S&P 500. But now we've looked at the scenario, what if you actually want insurance in case you die in 30 years, but you also want to invest? So you buy term and you invest the difference. If you buy that term life insurance, that 30-year term, you still have that protection, which is the insurance, and by the time you're 85, you have $891,000, which is much more than that $250,000 whole life face value. So basically, here is why it doesn't make sense, in my opinion, to buy a whole life insurance. What the insurance company is going to do is, we just saw it in this compound interest calculator, they're going to take your premiums, the $99 per month, and they are going to invest it. And basically, over your life, they're going to make way more by investing that money than whatever the death benefit is to you. We just saw this. I mean, if they're running the algorithms and you're going to live to 85, they're going to make $1 million off of your money, and then they're going to pay you $250,000. Now, one other thing that whole life insurance agents might try to sell you on is the cash value. So at a whole life policy, it has a face value when you die, but it also builds up a cash value that you can pretty much cash out at any time. But the important thing to know is, usually 99% of the time, you will never get the death benefit and the cash value. That is a big misconception. Most people will never get that. You'll never get $250,000 plus the $50,000 of cash value. And I'm just using $50,000 as an arbitrary number, but what happens most of the time is you will have some life insurance policy and it's building cash value over time. And let's say that cash value gets to $50,000, and by the time you're 80, you want to cash it out because you want to go on some last Europe bucket list trip or whatever. So you take that $50,000, and now that whole life policy is null and void. It's dead. They might try to convince you that's a better idea though, because with term insurance, there's nothing. But what happens is, most people still, what they're paying into that whole life policy, especially when you look at what they could be getting in investing, it is so much more than that cash value that they would get out of it. So this leads me to one last point here. So why do some financial services investing companies, even Warren Buffett's company, Berkshire Hathaway, why do they buy whole life insurance policies? There's one specific reason. Warren Buffett, Berkshire Hathaway, these guys that are really smart with money, these hedge fund managers, they would never buy whole life insurance policies on themselves. But what they would do is they would go to older people who have a cash value, and they would try to convince that older person to cash out with them instead. So they would buy that person's whole life insurance policy. So let me explain. You have an old guy here, let's call him Joe. He is 80 years old. He has a cash value of $50,000 in his whole life policy, but the face amount is $250,000 when he dies. Now, Joe is thinking, man, I kind of want to enjoy this money now. I want to get my $50,000 now because I want to go have a big family reunion with my grandbabies before I pass away. So I want to get this $50,000. So he could call the life insurance company and cash out at $50,000. Or a guy like Warren Buffett could come along and buy his life insurance policy. He could say, hey, Joe, Mr. Joe, you're going to get $50,000 from the insurance company. What if I just buy this life insurance policy for you? You name me the new beneficiary, but instead of $50,000, I will give you $60,000. Old man Joe is thinking, well, great, I get $10,000 more money if I work with Berkshire Hathaway. So then he sells his life insurance policy to Berkshire Hathaway, naming Berkshire Hathaway as the beneficiary. Now, of course, in 5 or 10 years, Joe dies. So the Berkshire Hathaway company, they paid $60,000 up front. For the next 5 years or so, they're paying $100 a month, and then they get $250,000. It only makes sense for Berkshire Hathaway to do this deal if the old guy, old Joe, is close to death. Because the closer he is to death, the less amount of time he'll have to pay. So it makes a lot of sense to do this for a guy who's 80 or 85 or 90, because they're only going to have a couple years left, and then you get, you pay 50 or 60 grand, you pay $100 a month for a couple of years, and then you get $250,000. So when whole life insurance agents say stuff like, this is a wonderful investment, even Warren Buffett does it, wrong. He does not do it for himself. He waits until some poor schmuck is 85 years old, and then he goes and offers the cash value for him. And they do that a lot, by the way. They buy those all the time for old men. But the moral of the story, you guys, is I personally would never get whole life insurance on me. And again, this is coming from someone who is a licensed life insurance agent. And I hope this video is helpful to you. I'll see you guys at the next one. Peace.